Okay, well, we're here with one of our portfolio managers on the investment committee, David Kletz. Dave, thanks for joining us.
Thanks for having me.
And we're here to talk about the region of the world called the emerging markets and have a spotlight on that. But before we get into the subject matter, Dave, can you just tell us a little bit about your role on the investment team?
So I'm one of the portfolio managers on Forstrong's investment management team, and I provide research and analysis to help guide the team's decision. Specifically, I focus in opportunity and currency analysis.
That's great. So opportunity and currency especially has been one of the big differentiators of our firm, and we classify opportunity investments as anything that's sort of not mainstream stocks and bonds. So emerging markets definitely fall into the opportunity category, and we have the great privilege of having Dave do much research on that asset category. So let's jump into it. So Dave, broadly emerging markets have been outperforming their developed counterparts this year, and can we explore that concept? Why is this happening?
So there are a number of positives underlying the recent strength in emerging markets. Firstly, the US dollar appears to be peaking. This provides a tailwind to emerging market corporations and governments that have borrowed externally, and it also lowers the risk of capital outflows. Low commodity prices have fed into tepid inflation. This has allowed emerging market central banks to pursue dovish monetary policy and put downward pressure on long-term interest rates. The valuation gap between Asian and Western countries is the narrowest it's been since 2003. That's the last time a secular bull market in emerging markets began. Fiscal easing initiatives in China and India should continue to support corporate earnings. With an improving economic backdrop, upward earnings revisions have been the strongest in emerging markets relative to any other major regional index in this year. And lastly, a global upturn has almost always been a reliable signal for identifying inflection points in emerging market profit and growth cycles. Since most EM firms typically have a high degree of operating leverage and work in globalized supply chains, their earnings and investment cycles are disproportionately influenced by changes in world trade and demand.
It's interesting that this has occurred just as the US elected an anti-globalization president and with a strong protectionist leanings. What do you make of all this?
It's certainly ironic that global growth has been accelerating while the world's largest economy has turned increasingly isolationist under the Trump administration. This positive economic momentum has been highly synchronized across global economies. All 45 OECD members are growing simultaneously for the first time in over a decade. This has led to a resurgence in trade activity, with EM exports exhibiting the fastest growth rate since 2011. While the US is systemically important to the global economy, we believe the biggest loser from trade protectionism will ultimately be the US themselves. America's withdrawal from the Trans-Pacific Partnership has opened the door for China to take the lead on new regional trade linkages, which should ultimately bolster efficiency and open up new sources of demand.
That's a great point, Dave. There's definitely changing leadership in the world. So let's talk about the path ahead for emerging markets. Does the outperformance that we've seen this year, does that have legs? Can it continue?
We believe the factors that have driven the recent EM outperformance are still in play. For instance, the US dollar remains overvalued by most conventional metrics, inflationary pressure will likely remain muted, and emerging market stocks are still attractively priced relative to their developed market peers. In terms of the current rally's longevity, it's interesting to study recent emerging market cycles. Emerging markets underperformed US stocks for most of the 1990s, especially in the latter part of the decade. But from 2000 on, however, they outperformed the US for 10 out of the next 12 years. We believe we're at a similar inflection point today, with a longer running EM cycle just beginning. It's also important to recognize that emerging markets have already had a large slowdown between 2010 and 2016. Since then, currencies have weakened, which has boosted competitiveness, commodities have fallen, which has raised consumption, and policies turned stimulative, which has lowered the cost of capital. These benefits should show up with a lag.
All right, well that sounds great, Dave, but we're money managers and we're paid to worry for clients. So what risks do you see out there? Specifically, the US Fed raising interest rates has always been negative for emerging markets.
Yeah, most emerging market central banks have historically replicated the US Federal Reserve's interest rate moves. Because the US dollar is seen as a leading indicator of global business cycles, EM countries, especially those with hard or soft pegs to the US dollar, tend to broadly imitate the Fed's interest rate moves to prevent our interest rate gap from opening and from capital outflows from following. This has not been the case thus far, as the Fed's monetary stimulus has been very slow and deliberate, while a mild inflationary backdrop has persisted in most markets. However, the US dollar remains the world's reserve currency. A tightening of liquidity conditions reduces risk appetite, while higher rates make it more difficult to service external debt. Accordingly, policy risk is a key variable we're watching closely.
Okay, that's great. Policy risk is I think, not only a risk for emerging markets, but also developed markets, and that definitely is one of the key risks that we're watching for portfolios. So last question here, Dave. Can you tell everyone how we go about selecting the right exposures within the emerging markets universe?
So the emerging markets umbrella is extremely broad and represents a highly diverse collection of global economies which can have significantly different growth drivers. When evaluating the EM universe, we look at these underlying market dynamics to help position client portfolios. Specifically, we currently prefer commodity importing emerging markets, which should continue to benefit from the recent downturn. We place high value on reform-oriented nations who can increase efficiency and attract foreign capital. With an aging demographic profile in most developed countries worldwide, we look for exposures to younger populations with educated labor forces. And lastly, we reward prudent fiscal and monetary policy. A number of emerging markets have adopted floating exchange rates, built international reserves to offset capital outflows, and implemented inflation rate targeting monetary regimes. These developments help strengthen the investment case and ultimately reduce risk.
Great stuff. Thanks so much for joining us today, Dave.
Thanks again for having me.